All right, guys, we're going to go ahead and get started with today's class. I've coined the term lunch and loan because it's kind of a lunch and learn regarding loans. So I'm going to just dive right in here. We're going to be talking about buy downs. And we've been doing buy downs now in this market for quite some time. I would say my team has been doing them for almost 2 years now, maybe a little longer, since we had the rates start increase when they were in the threes and people got to the fours. We started doing them then, but now they are more important than ever in this higher interest rate environment. I just got done watching Powell, and there's a Q&A right now. So the bond market is happy right now, which means rates may get a little bit better throughout the week. So that's a good news. But in the meantime, let's go ahead and talk about how to buy these rates down to get your buyers into some more cost-efficient payments. And we're going to go over everything in detail. And if there's any questions, if you're confused at all, use the chat room, use the chat box, use the Q&A, and put your questions in there. So first off, we're going to go over just the basics, right? What are the different buy down options? So if you look at the buy down options that are out there, there's temporary buy downs, and then there's permanent buy downs. So I'm going to go over these in a lot more detail. You can do one or the other or both, and we're going to go into that. So first off, what is a temporary rate buy down? This is a seller funded account. It's money collected from the seller that the buyer puts into a little account, and every month we will dip into that piggy bank, so to speak, and supplement our buyer's payment to make that payment equal to a discounted rate of whatever the buy down is, whether it's a 3-2-1 buy down, a 2-1 buy down, a 1-1 buy down, or a 1-0 buy down. As an example, if the rate right now is 7.5, I think I have some illustrations here at 7.625, but let's just say it's 7.625 and it's a 3-2-1 buy down. We're going to use every month, we're going to dip into that piggy bank and we're going to take some money out and we're going to supplement that payment so that the buyer only makes a payment based on a rate of 3% lower the first year, 2% lower the second year, and 1% lower the third year. And then it goes to the normal rate of the 7.625 for the rest of the loan. Now that's based on rates right now. So the 3-2-1, the 2-1, the 1-1, the 1-0, what those numbers mean is the reduction in rate for the first year, meaning the first number, the second year, the second number, and then the third number is the third year. So that's the discount on the rate. And keep in mind, the rate is permanent. So the rate is at 7.625 forever. It's just we're using the seller's funds to supplement the payment to make it feel and look as if the buyer is making a payment based on a rate of 3% below. So in this case, it would be 4.625. So pretty cool system. It's a great way of really helping your buyers get into a rate that is much lower than the going rate right now. Now, some unique rules on this. The only person that can pay for a temporary rate buy down is the actual seller. Nobody else can contribute. So the realtor can't contribute. The buyer can't contribute. The only person that can pay for it is the seller. Now, you may say, well, how much does this cost? How do you figure out how much to ask for in the offer? That's where I will come in. There's a lot of rules on that. But in a nutshell, the savings that you're going to get by paying that lower rate is exactly equal to the cost that the seller is going to give. So it's basically the seller helping you the first 3, 2, or 1 year with the payment so that you have an easier or a lower payment for the first couple years of the mortgage itself. So again, 3-2-1 is 3% less the first year. The second number is 2% less the second year. The third number is 1% less that third year. And then it goes to the permanent rate for the rest of the loan. Now I'm going to show you this in a report so you can really wrap your head around it. Only the seller can pay this, and we have to be very, very careful because when you're setting these up, there's very specific rules with each of the different loan programs as far as how much the seller can pay per the guidelines of that mortgage. We're going to go over that in a little bit, but we need to really make sure we're cross-referencing that when we're setting up our offers to include seller credits to do these buy downs. Now, another great feature about these temporary buy downs is that, let's just say the buyer closed on their loan, they're in it for the first year, and then, oh my gosh, rates drop to 5%. And they're like, well, I want to fix it in now forever. But they're not done with the first 3 years of discount, and there's still money in that piggy bank that the seller gave them, but they want to fix that rate in permanently. They want to refinance. Well, with the temporary rate buy down, any money that's still in that piggy bank, so to speak, that the seller gave that hasn't been used gets credited towards the buyer's loan balance to lower their loan balance. So that money does not get wasted. They get that money back in the form of a loan principal reduction. So that's one of the greatest pieces of this, because you might have that argument from a buyer like, well, I don't want to spend all of that money if I'm just going to refinance in a year anyhow. Well, in this case, they do get that back. So that is a temporary rate buy down. You can do a 3-2-1 buy down. You can do a 2-1, a 1-1, and a 1-0. Basically, it's as if you're saving 3%, 2%, 1%. And then the second one is cheaper. It's only a 2-year plan. You're saving 2% the first year, then 1% the second year. And then 1-1 is your 1% the first year, 1% the second year, and then it goes to a normal rate. And then the 1-0 is just savings for 1 year. There's a question here. Could it be used towards the refinance? No, it's just a principal reduction. It's not real money to be used. Now, keep in mind, we are refinancing all of our customers that close a deal with us with no lender fees in the future. So if you are a customer of us already, you will enjoy a free refinance when it comes to the loan costs. Now, there are some escrow fees involved with the transfer of title, but it's very cheap compared to purchase to do a refinance. So now, another key point on this is when you're doing a temporary rate buy down, you still have to qualify at the actual real rate of that transaction. So in this case, it'd be 7.625. Even though their first rate, the first year, the rate is going to be, the payment is going to be based on a rate of 4.625. We are still going to calculate everything on the higher rate at that 7.625. So it's not going to help them qualify when you do a temporary buy down. We'll get into some features of the permanent rate buy down in just a second. So that's the temporary rate buy down, and we're going to go over more details on that right here. So I'm going to move my face out of the way. So how much does it cost? Now, I've got some calculations that I use to really help this. Again, the cost is equal to the savings. So here's a breakdown. The top portion right here is a 3-2-1 buy down. So assuming the rate's at 7.625, if we were to have a payment of 4.625, normally the payment would be $4,459. The new payment, based on this lower rate, is going to be $3,239. Now, as you can see, that's a huge savings, $1,220 per month. Over a year, that annual savings is $14,640 and change. Okay, so that is the first year. The second year at 5.625, we're discounted. The monthly savings is $832 a month. Over 12 months, that's a total savings of $99.89, and so on for the third year. And then you add all of those together to get the total savings, which, guess what, is exactly what it costs for this program and exactly the dollar amount that we need to ask for when you're making the offer, when you're going to go ahead and look for a 3-2-1 buy down for your buyer. So the cost equals the savings, and this is how we calculate it. It's pretty easy to do with a quick Excel spreadsheet, but I have a little formula that I use. So if you need those numbers, that's what I'm here for. Now, the 2-1 buy down, it's the same exact thing, except you don't get that first year with the 3% below. It's 2% below. You add it up, and then there's your saving. That's your savings, and then that's the cost, what we have to ask for the sellers. And then below is a 1-year program, and it's very cheap, as you can see, $5,100, but you only get 1 year's worth of savings. So this is how we calculate how much it actually costs. So if you are making an offer and you just say, you know what, I need 3%, it may not cover everything. So we need to know what the exact number is on these buy downs so that we can ask for the number that is required for us to get this strategy in place. Is the refinance free in the language on the contract? I have a coupon, I guess you could say, or a flyer on the free refinance. So if you need something like that for your customers, I'm happy to provide that for them. But it's not there's no contract. It's in the initial closing, there's no verbiage in there in regards to that because they're all templated documents. Good question. All right, so we're moving on to the next one. What does it look like now? So here's a breakdown of the savings, and of year one, it'll be 4.625. Your payment, including taxes and insurance and HOA, is $39.28. This year number two, it's $43.15. Year number three, it's $47.22. And the remaining life of the loan is $51.48. So if you have a buyer, and this is perfect for the buyer that is, let's just say they're just getting into a job and they know they're going to be making a lot more in the near future. Let's just say it's a commission-only job. Not commission-only because it'd be hard to qualify for that. But it's a job that has commission, and they know in a couple of years they're going to be making a lot more. This is a perfect scenario for them. If they know that they're going to have extra income in the future because right now their wife is on maternity leave and not working, whatever it may be, but they know in the future she's going to go back to work, another circumstance that would be perfect for this. But keep in mind, this is temporary. It's only going to be for the first 3 years. So we need to make sure that we're setting the stage for what it's going to look like for a refinance and what's the worst case scenario for them in the remaining years if the rates never come down. So that's why I present it this way, to show what the future payment will be. And then I'll go over what the refinance would look like. And from there, we can make a strategic decision on if they want to move forward with this type of a program or not. So that's the 3-2-1 payment breakdown. A 2-1 breakdown or buy down and a 1-1 buy down is very, very similar. But it's just going to have the lower rate for the first year is going to be the column number 2 in this one. And so on and so forth. So as you can see, there's a significant savings for the buyer. The seller does pay for it. So what is a permanent rate buy down? This has been around forever. Everyone does it, but they don't know what it's called. Anytime there's points associated with a loan, you are buying down the rate. So a permanent rate buy down is where you pay extra in points upfront to get the lowest rate possible at that time. And the good thing about this is it is permanent. It's going to last the entire life of the loan. So if you can look down here, I'm going to show you this kind of where my goofy mug is. This is a rate sheet on the right-hand side. This rate sheet is going to show you what the costs are for the rates available this morning. Now, they're going to be better in a couple hours here because the bond market's rallying right now. But in regards to what it costs, let's just say your buyer says, you know what, I can't qualify unless I have a rate that's much lower. At these higher rates, the price point that I need, that I want, I don't qualify anymore. But if the rate was 5.99 at that payment, I can qualify for that. Well, let's look at that. So 5.99, and you're at it'd be a 6.686 APR because look at these points. So the principal and interest would be $3,773. This costs 5.23 discount points to get. Can you get it? Yes, but look at the costs for that. It is a pretty hefty cost up front to do this. Now, anyone can pay for a permanent rate buy down. That's the joy behind this. The buyer, any of the realtors can give credits. The seller can give credits for concessions to pay for this. The question is, though, unless it's absolutely mandatory for qualification purposes to get into a house right now, that's one thing. But I do think that rates are going to be in the 5s in about a year or two, no matter what, either way. So does the buyer really want to spend that money out of their own pocket to get a rate where they're saving a couple $100 a month for just a year or two? Will you get that savings? And where's your break-even point? We can go over that in detail. But if the buyer is looking for it because they need that house right now to qualify, and if the seller's paying for it, great. Let's get them into a 5.99 forever. You qualify at the lower rate. Now, you can qualify for more using this, but I want you to know this. When you first pay for this at closing and you pay that 5.23 points, that money's gone. There's no refunds anymore if you refinance. That money is used. It's one and done. It's gone forever. So it is a commitment if you're going to be doing a permanent rate buy down. But you qualify at the lower rate. Anyone can pay for it for the cost. It's a one-time cost at closing, one and done, but you can't exceed the seller concessions allowed for that loan. So as an example, if you're doing a conventional loan, and again, I'll go over this, the nice little cheat sheet I have for you in just a minute. If you're doing a conventional with 5% down, your cap is 3%. So you can only get like a rate close to 6.5 because you can't exceed 3% of the purchase price in concessions. So we have to be careful that we don't set improper expectations on the different rates available based on the caps that we have for the loan program. FHA allows up to 6% regardless. So you could easily do this with an FHA loan. Conventional with 5% down or less is only 3% you can ask. So there are some limitations based on the loan program. So it's really important to cross-reference here. But this is what a rate sheet looks like every day. So when people say, what's your rates? Today I can say my rate is 5.99. And then they're going to say, wow, that's really good. I'm like, absolutely, but you're going to pay an arm and a leg for it. So rates, when they're advertised, you need to be careful because what does it actually cost for that rate? And this is a behind the scenes look at what exactly it costs. So today, this morning, if you looked at a rate that didn't cost anything, you'd be at the bottom section, 7.5, 7.625. And look at that, 7.625, you're actually getting money from the lender, $1,455. So the higher you go in rate, the more money you actually get. But this is a permanent rate buy down, and this is kind of how that shakes out. Any questions on that? Okay, so there's a question here. Let's see. Are you seeing rate buy down verbiage in section 8 of the contract? Not rate buy down, we're just seeing concessions. We're just looking at it as concessions. If you want to put in the comments section that we're using it for rate buy downs so the sellers understand why you need so much, great, you can do that. You don't have to, you can just ask for concessions and we can use it towards that. A lot of times they'll ask me when I'm calling when an offer is made, do they really need those concessions? And my answer to them is they are expecting to get a 3-2-1 buy down. This is the money they need. So yes, and then on the pre-qualification, I'll check that box. Buyer does require concessions for this offer. So that's usually how we set that up. So good question. Okay, so we're going on, moving on. So what's next as far as buy downs go? And it's stacking buy downs. So this is my own term. I coined this and I posted this to YouTube about 2 years ago. I don't think anyone uses this, but hopefully it'll catch on. But stacking buy downs is a combination of doing a permanent rate buy down and then doing a 3-2-1 or an additional type of buy down on top of that. So both of my kids have bought homes doing stacking buy downs, and it's phenomenal. And this is one of those loans that requires a lot of seller contributions. So here's how it works. On the right-hand side, you pick your permanent rate. What do you want? Let's just say you have only 6% to work with. We already know that the temporary buy down is going to cost 3-ish%, so we need to know what the exact dollar amounts are. But let's just say it's 6%. So we're going to buy the rate down to 6.5. We're going to use that. That's going to cost $19,889. Okay, follow me on this. We're going to buy it down to 6.5 permanently. So the permanent loan, instead of 7.625, we're at 6.5. The permanent loan is based on that. Now, you add a 3-2-1 buy down to that, and now you're 3% below that permanently purchased rate buy down of 6.5. So now your first year, you're at 3.5. And then the second year, it's 4.5, then 5.5, and then 6.5. So if you have a buyer that says, I won't buy a home unless the rate's 3.5, I'm going to wait for rates to come down. You can say, you know what if I was to get you a rate of 3.5 now, And when rates do come down, like you say they are, because you're the expert, then we can refinance into it then. But right now you'll have a much lower rate. Would you be interested in buying in those circumstances? So we need to have those conversations. Be careful because this can get expensive. Now, the seller's still the only one that can pay for the 3-2-1 buy down, or the 2-1 buy down, or the temporary buy downs. That portion of it can only be paid for by the sellers. But anyone, including the buyer, the realtor, anyone can pay for the permanent buy down. So again, the cost for the temporary is paid for by the sellers only. Permanent buy down can be paid for anyone. You put those together to get a massive savings. And be careful on concessions. This is one where it gets sticky. And obviously we need a seller that's willing to give those types of concessions. Again, if you refinance this where you stack the buy downs, the cost for the permanent rate is gone, but any money in that piggy bank that you still have for the temporary buy down that you haven't used to supplement your payment yet, that money gets credited towards your loan balance. So kind of a win-win there. Fantastic way of getting really, really low rates. Here's a question. Will the seller buy down should be less if you are starting in a lower beginning rate? Yes. So if you look back at the seller buy downs, the costs here. So if you look at the cost, this one is really low. So I think I know, I'm following where you go. A 3 years more expensive than a 2-year, but if the rate is lower overall on the stacking buy downs, the cost is lower. So the cost to the seller is then lower if you have a lower overall permanent rate. I believe that's what you're asking. So if you're buying down the rate permanently and then you're doing the temporary buy down on that lower rate, the savings you're going to have and the cost is much less than the one at the higher rate. So yes, it would be cheaper for the sellers in that circumstance. And that's where it really is important that your buyers understand this and have a very well presented report that's going to show exactly how everything works, because it can get a little confusing. And here's that little breakdown. I love Cousin Eddie, you serious, Clark? I use that quote throughout the year. But this is what it looks like with the 3.5 rate. The first year, you're at $3,500 and change compared to $4,600 and change. Massive savings. And again, it's temporary, but the permanent rate you bought it down to is permanent. So if rates never come down, at least you have a very nice permanent rate moving forward compared to where rates are right now. So here's your cheat sheet. We're going to go over a few more really neat presentations in just a second. But here's your cheat sheet. If you don't have this, you can easily Google it. There's a million of them out there. Seller concessions cheat sheet, they're everywhere. But this is the one that I have. Conventional, if you're doing less than 10%, you can only get 3% from the seller. The down payment of 10 to 25% on a conventional loan, it bumps it up to 6%. And if you're doing more than 25%, you can get 9%, and you can go hog wild crazy with getting really, really low rates. So that's conventional. Investment properties with conventional, you can only get 2%. So if it's an investor looking to buy the rate down, there's not a lot of room that they're given because the sellers can only get 2% when you're purchasing an investment property. Now, FHA, it's always 6%. So 6%, you can't go more than that, but 6% is a really good starting point, especially if you only have 3.5% down. You can start right out of the gates and get everything you need to do a permanent and a temporary and stack those buy downs for maximum savings. VA is actually unlimited, and you can charge up to 2% in discount points. You can actually include paying off, the seller can actually pay off debt to help the buyer qualify. If you do that, then the most is 4%. USDA is 6% as well, following the same as FHA. So this little cheat sheet, we're going to reference back and forth quite a bit to make sure that when your buyers are making an offer, their loan program will allow what you're asking for. The last thing you want to do is make an offer and you ask for too much. And then at that point, you can then, if it's accepted offer and you've asked for too much, you can use that and do a purchase price reduction instead in lieu of those concessions. So there's a lot of ways you can get creative with that, but you need to be careful. All right, so this is confusing. Your buyer's thinking, okay, 3, 2, 1 buy down, permanent buy down, stacking buy downs. I don't get it. So I want to show you how I present this to customers. So I've created these little links in here. So if I click on this link, this little 3, 2, 1 buy down comes up. And here it is over here. Bear with me one moment. This is what it looks like on the 3, 2, 1 buy down that I present this to the buyers. I do it live from my computer. When I highlight something on my computer, it highlights it live on their computer and we walk through it. So basically I say, okay, this rate buy down that you're doing at 3, 2, 1 buy down is going to cost the sellers $29,731.44. We are going to ask for that in a seller credit. Now you're putting 10% down. So if you look at year number 1, we're going to have a purchase price of $700 and we're going to have a loan amount of $630. Your first year interest rate is going to be at 4.625. It's 3% below what the permanent rate is, which is a 7.625. Your payment every month, you don't need to think about it. You don't need to do anything about it. It's automatically going to be on your statement, is 4.625. Your payment, including everything, is $3,928. The second year, it's going to be $43.15 for the next 12 months. The third year, it's going to be $47.22. And the remaining 26 years of the loan, it'll be $51.48, or we refinance in between and get it into a permanent rate that's lower. So I'm going to tell you how this breaks down as far as payment breakdown. You've got your principal and interest payment. The first year is going to be $32.39. Your property taxes are $325. Your insurance is $125. You've got mortgage insurance because you're not putting 20% down. So your total mortgage payment is $38.78. Now you do have a $50 HOA fee. That's going to be paid separate. So your total housing obligation is $39.28 the very first year. Now, is this payment comfortable for you? Is this going to fit your budget? Do you understand how it works in the future, how your payment could go up because the next year it's going to be $43.15? Do you understand how that works? Now, the permanent rate is higher. So after that, if you don't refinance, it will be $51.48 in the future. Are you comfortable with that? We have this conversation. We go over it in detail. We present it. It's really slick. And then they're able to see exactly what it costs and exactly where everything is. And then I go into the closing costs as well. We go over all of that in detail. Everything's broken down and itemized. We have a fee detail program. It goes through every last fee. We go everything in detail. I call this the total cost analysis. We do this with every buyer, by the way. Every one of our buyers goes through this program and they see the different options available. Available to them. And we go through all of the fees, all of the cash to close, everything that's involved. After this presentation, they're going to know exactly how this all works. They're going to know how much they're going to ask for, why they need to ask for that. And then we're going to go into one more option here. I'm going to show you the stacking buy downs. So it's the same presentation. We're going to look at, now this one I have highlighted. They're going to see that on their computer. This one, the payment's much less. We're going to show them what their permanent rate is going to be. We're going to show them the savings, and we're going to show them the savings over a 5-year period. We're going to show them the interest paid over the first 15 years, depending on the rate that they're doing. So really comprehensive, and we're going to go through this in detail. Again, we're going to go over their closing costs. We're going to do the payment breakdown. We're going to go over everything in detail so they can see every last piece of the loan and what's being charged. Fantastic program, guys, but we need to understand how to set this up properly. So that's stacking buy downs. Again, the permanent rate buy down, I do a lot more often, and that's what this is what this one looks like. Here's your rate options, and here's the costs. I do this on every loan, regardless of what they're looking at, because people say, what's your rate? and I say, well, what are you willing to pay for? And what's your budget? And what's your comfort zone? What's your cash out of pocket? What makes you sleep better at night? Does cash in hand feel better than I really need that lower rate? Let's look at it. Let's explore it. And let's look at the cost differences. So I go through the rate differences, the payment savings between the lower rates, and then I go into the closing cost section and I illustrate what the points are associated with these loans. Yes, they can get very expensive. This is what the lenders online don't say. They say advertised rate of 5.99, and then there's an asterisk, and then everyone says, oh, I saw online I could get this. Well, they're not showing you the devils in the details, the big costs involved. I'll go through that in detail so they know what their options are. And again, anyone can pay for those. So if the seller's only willing to give $14,925, then we can lock in at 6.75 today, because that's what the seller is willing to pay. So we can move around the rate sheet based on what the seller is willing to give towards closing costs. And that is the permanent rate buy down. And again, I usually give this to every single buyer. If they just want a rate with no points, I have that as an option in here. I have an option with a higher rate without paying any lender fees or any closing costs at all. And then we have a couple rates that are lower, just in case they wanted to get a lower rate and a lower payment and pay a little extra in discount points. So all of these can be used together. You can stack these buy downs, and I'm telling you, it's a great way to help your buyers understand what their options are in a high interest rate environment. So I'm going to get rid of this one now. And that really does kind of end our presentation on that for now. I'm going to jump back into the normal Zoom. I'm going to stop sharing here. And